Hey, future retirees. Did you know that you could lose as much as a quarter of your retirement savings without ever even spending a dime? In this video, I'm going to talk about a common retirement mistake that is so common and so costly, it could cause you to change forever how you think about your 401k. Let's dive in. Today is Tuesday Tactics. What are we talking about? Money moves that maximize retirement. We are talking about things that are near and dear to the retiree. Specifically, how do you shift from saving, accumulating the working years to retirement, which we call the distribution years or the spending years? And how do we actually physically turn our account values into actual income, things that we can use to pay our bills and travel and do all the things that we want to do? What are the actual mechanics of how we derive income from our investments? There's a lot of ways to do it. I think the typical way that we see out there is mostly we save a nest egg in a market-based account. So an account typically like an IRA or a 401k, a workplace account. And within the account, we own market-based assets. So things like stocks, bonds, mutual funds, assets that are volatile in a marketplace. So they have prices. They go up and they go down. And the challenge for the retiree is if once you start spending that money, is it through actual selling of securities? So we go in, we sell stocks, we sell mutual funds in order to liquidate the cash that we use to pay our mortgage and spend our bills. Do we live on interest? Maybe our investments derive some form of interest that's credited and we sweep that interest cash out of the account and use that to pay our bills. The challenge becomes, if the markets are volatile and we start spending money, you could have a very powerful 1-2 punch in the wrong direction, meaning you could have to sell assets in a down market. And the math of loss is pretty powerful. So just kind of as an aside, I always tell people, if you invested all of your money with me, and let's say that was $100, and in the first year I lost 50%, and then we're going to have to make assumption that you didn't either shoot me or fire me, but I convinced you to hang on with me through year 2. And in year 2, I really sharpened my pencil, got down to business, and I earned 50%. So the first year I was down 50, the second year I was up 50. Well, where does that leave you? What is your current dollar amount? See, a lot of people would say that I'm back to my $100, and that's a critical error. It's because the math of loss works differently when we're spending money. So if I lost half of your account in year 1, but I gained 50% in year 2, what did I gain 50% of? And the answer there is I gained 50% on 50% of your original investment. So year 1 took me down to $50. So if I earned 50%, I'm only earning it on $50. So the net result is I'm not back to zero, I'm down 25%. So I'm sitting at $75. And that math can compound itself over time. You know, when we're saving, when we're accumulating, markets go up, markets go down, but the average, all averages will get you to the same place. So as long as the market averages 8%, every accumulator who's investing the same amount of money with the same timing will land in the same place, regardless of how that 8% was achieved. It's a really different world for the retiree. The retiree and us in general, we don't get to live on averages. And we make a lot of our investment decisions and a lot of our asset positioning based on average rates of return. So for the retiree, it's no longer the average of returns that matters. It's the sequence of those returns. It's the order in which you get those returns in the marketplace. And the problem is when you're standing at retirement's doorstep, maybe at age 65, 62, I'm not sure, but you've got to look 20 years into the future and you have really no concept of what the market will bring you over that period of time. We know that the market generally has returned positive results over nearly any 10-year, 20-year period. And that guides us on our way up. And we feel comfortable with that. But on the way down, now it's the volatility of the market that drives the challenge. And if you retire into a down market, there can be damage to your retirement portfolio that you neither have time nor money to recover from. So I always say retirement doesn't give you a lot of do-overs. Scary stuff, right? But don't worry, in the next video, we're going to talk about strategies to protect yourself even during a crashing market. Subscribe so you don't miss it, and comment in the section below. Has anybody ever told you about the sequence of returns risk?